Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome, everyone, to episode 172 of the Independent Advisors Podcast, where Mark McEvily and Matt Jessup bring you everything you need to know from the past week in the world of financial markets and financial planning. And as you can tell, there's no Matt and there's no Mark this week, so we've got two guys coming off the bench. So Aaron here, and then you guys have seen me the past couple of weeks. I'm Nick, Director of Research here. So it's been a while for you. Welcome.
It has been
back.
Been a while since I've done the podcast. I'm excited to be on it. Excited to bring the listeners some good info, and I've got some good financial planning topics to cover. So I think it'll be a good one today.
Yeah, so it'll be fun. This is the first time Aaron and I have done this together, so we're looking forward to it. So as you guys know, we always bring the pricing, but we start with the pricing numbers. So I'm going to recap this. This is as of the market close on 10/19. The S&P 500 is up 3.1% month to date and down 22.5% year to date. The Dow Jones is up 5.9% month to date and down 16.3% year to date. The NASDAQ Composite is up 1.0% month to date and down 31.7% year to date. The iShares Russell 2000 ETFs. The ETF is up 3.8% month to date and down 23% year to date. And the Vanguard FTSE All World ex-US ETF is up 0.9% month to date and down 27% year to date. Checking in on yields, our 3-month Treasury rate is currently sitting at 4.07%. Our 2-year rate is sitting at 4.55%. And the 10-year rate is sitting at 4.14%. So some movements and the yield curve, but still inverted on those the 2 and the 10. The 2 and the 10, but the short term coming up a little bit from last time we spoke, I believe. Moving into big headlines and current events. So a lot of news, and we've talked about this in other podcasts, but a lot of news coming out of the UK. And on the 17th, the UK Finance Minister Hunt, the new finance minister, scrapped most of the tax measures for their mini budget, which was a pretty welcomed sign from an equity side of things. The S&P is back above the 3570 level, which is fantastic from a technical perspective.
Yeah, that's good. I think that's a really big place of support for the market. So I think it's going to be a good place to hopefully see the market move higher from there.
Yeah, absolutely. That's the hope.
Exactly.
When we were talking about the technicals, I don't know if it was last week or 2 weeks ago. That level is really above that new low that we saw, so it's kind of a nice support base between here and the June low. So always nice to see. And let's see here on the 19th, we had a kind of a slew of you could say negative factors for equity movements, and this was yesterday. So the Minneapolis Fed president, Kashkari, he's an FOMC voter. He argued that the Fed funds rate could go above 4.75 if there's no improvement in core inflation. So the market doesn't love to hear that. The expectation for the ECB to raise rates by 75 bips at their next meeting in October. Then the UK inflation came out at a 40-year high at plus 10.1% year over year in September. So a few negative movements yesterday, but the market handled it in stride. We're still well above that technical level. Right. And then at the same time, we had some positives yesterday because we're in the middle of earnings season, and we're going to get into that with some of our research. But I would say it's a decent to strong start for earnings season. We saw a bunch of prints from the banks, and some were disappointing.
Some were pretty good.
Some were very good. Yes, exactly. And then Netflix and P&G, and then United Airlines all had pretty strong prints. So kind of a mix of this, some positive corporate news yesterday, and then some, you could say, expected kind of negativity
Right.
from the economic side of things. So,
Yeah.
but the market's been holding up pretty well.
Yeah, it's good. There's been a lot of news coming out of the UK recently. Did you want to maybe explain to the listeners what the gilt market is, if they maybe don't know what that is?
Yeah, that's a great point. So the gilt market is essentially the UK Treasury. It's their version of the Treasury market.
Exactly.
So we call it Treasuries here. They just call it gilts. They're government bonds. Yeah.
Yep. So essentially, what they're doing, from my understanding, is they're selling these, let's call them bonds or UK Treasuries, to have sort of quantitative tightening. Is my understanding.
Yeah.
Okay. So I just thought it'd be good for listeners to kind of have a little bit more background on what that is and what that means for those kind of actual headlines. So that's good, though.
Yeah, absolutely. So I'm going to toss it over to you, and we'll move right along into tweets, articles, and research from the week.
Perfect. I have a couple good ones here. So this first article that I stumbled upon is going to be from Advisor Perspectives, and it was released on 10/17, so just a few days ago. And it's about avoiding the midterm election trap from an investment standpoint. So I'm not going to read the whole article, but I just kind of wanted to paraphrase kind of the main points. And this article was written by Michael Joseph. He's a CFA as well. So some good info coming from him. So essentially what the article is getting at is that it really doesn't matter that much who's in office. The important thing is to kind of invest no matter who's in office, right? Staying in the market. So a lot of people will get in the trap of investing just for the party that they like and thinking that, say I vote Republican, hypothetically, I'm only going to invest during that time, right? But the data going back really shows that you should just be invested no matter who's in office. There is a little bit of information here, and there's a really good chart that shows the annual change in the Dow Jones given different scenarios. So obviously currently we have a Democrat president. With the midterms coming up, this is really kind of pertinent in my opinion, because there's kind of a couple scenarios or three different scenarios that can happen going forward. So the three scenarios are obviously of a Democratic president. If we have a full Democrat Congress, the annual change year over year is about 7.4% on the Dow Jones. If there's a full Republican sweep, the Dow Jones tends to be up about 16.4%, so quite a bit stronger. And with a split Congress, there is a 11.7% annual change. So in my opinion, all of those returns are good. So you shouldn't invest no matter what, shouldn't stop investing in the market no matter what happens. But it is interesting to see that gridlock really does gridlock is good in a sense for them. It might not be good for a policy standpoint and things getting done,
right?
But from the market standpoint, predictability is key, I think, for the market.
That's exactly what I was going to say. Is when I look at that chart, it doesn't really surprise me that the market wants gridlock because the market wants, like you said, predictability.
Right.
We don't, market participants, we don't want these huge swings in fiscal policy. We want it to be more predictable. That's what the market's always looking for. So not too surprising, but very interesting nonetheless. And we'll throw this chart up for listeners as well.
Yeah, it's pretty quick, easy chart to look at. But and that chart is from the Stock Traders Almanac from Wiley as well. So it's data going all the way back to the 1949. So it's had a lot of data there, and I think that's in my opinion, I think we're likely going to see a split Congress. So I think potentially there could be good returns going forward over the next couple of years. But I think gridlock is a good thing from the market's perspective.
Yeah, definitely. I think you hear, and I've heard this a lot just from my own friends and random fodder with acquaintances and whatnot about people getting concerned about market performance under different presidents. And when you look at the numbers,
it doesn't matter.
It doesn't matter. Yeah, it really doesn't.
Yeah, exactly. Okay. I'm going to take it again, and I have another article. Unless you have anything else on that topic. You good?
No, let's keep rolling here.
Perfect. So this is another article, and this is going to be by Ben Carlson. It's his blog, which is really good. It's called A Wealth of Common Sense. And this article came out 2 days ago on 10/18. So this article is titled Bear Market Opportunities for Every Generation of Investor. So I
peeked ahead. I really like this.
Yeah. So even though it might feel like this challenging market environment, there's no good that can come out of it. Yeah. I think there are some positives to look at. So maybe I'm a glass half full kind of guy, but I think this is a really, really solid article to kind of provide some reassurance for investors, no matter what age range, what generation you're in. There's opportunities to be had for all of you. So essentially what the article goes through is baby boomers, it goes through Gen Z or millennials, and it goes through Gen X, or kind of the middle-aged people, right? So one positive thing to come out of this unfortunate period of time is rising yields, right? So for many investors, Ben says, with the risk curve earning higher than expected returns recently, many investors have been in a traditional 60-40 mix of stocks and bonds because yields have been so low, right? They may have been even higher, 70-30 or 80-20, again, because yields have been so low. So most people were higher risk, in my opinion, over the last several years because you needed to get some sort of return because yields on the market were so low. So there's a chart that he has in here, and it's investors can finally earn some yield on bonds. So 1 year ago today, 30-year treasuries were yielding 2%. Today, they're yielding 3.79. 2-year treasuries were earning 0.27% or 27 bips. And today they're earning 4.2. Yeah. I know you went through all of those,
which is colossal.
It's a massive move. And obviously that's with what the Fed is doing with raising interest rates, but it's nice. And I think these rates are going to hang around for a little while. So even in my opinion, I think the market's going to recover in the next couple of years. I still think these higher yields are going to hang around for a little while. So it's nicer for people that are retired. They don't have to be as dependent on equities to actually get a return in the market. So
exactly.
I think that's a good opportunity. Again, it's not fun for those maybe close to retirees or retirees that have seen swings in their portfolio, but just a little bit of good, I think, can come out of this with those higher yields for those investors.
Yeah, for sure. Especially when you think about what we've gone through in the past, however many years, the bond market has been deflated.
Exactly.
And has pushed more and more people into equities. And like you say, bringing up their risk. Now, people closer to retirement, and when you look at locking in a 4% return, and let's say you're in a 60-40, this is a very simplistic example because you would probably layer more products in your 40%. But if you were just going to buy one treasury bond for 40% of your portfolio, you could lock in a 4% return for 5 years on 40% of your portfolio. I would think that most retirees would feel pretty good about that, or people kind of in that, maybe 3-4 years away from retiring. You feel pretty good about that. Yeah. I mean, I know it's nice to see yield in the markets, and Mark and I have talked a lot about that. It's kind of refreshing.
Yeah, exactly. So next thing the article goes on to say is about Gen Z or millennials. They're kind of lumping younger investors all together right now. So
the young guns.
Yeah, the youths, I like to call them. So young people are on the opposite spectrum of the compared to retirees. So I'm going to read through his little article here on this. Young people also need a safe place to park their relatively safe assets for emergencies, down payments, weddings, and other short-term financial goals. But your biggest asset as a young person is your time horizon and your human capital, right? So you really have to allow compounding to be the wind at your back. So I think for younger people, the S&P being down 25% plus at one point is a fantastic opportunity, right? Whether that's you have money on the sidelines that you can put to work, or whether it's your dollar cost averaging by saving to your 401k or to any sort of investment plan you may have, just continuing to do what you're doing, I think you're going to be better off in the long run while having some of these market downturns. So for people under 40, I kind of welcome some of these more volatile periods of time because you can buy in at such a discount, right?
Absolutely. So, especially if you have cash on the sidelines.
Exactly. So there's a chart that it's titled "Buying When There Is Blood and the Street Works," and it's going to show the forward returns of the S&P 500 when it's fallen 25% from all-time high. So I'll just cherry pick a few here. So kind of the last similar numbers in 1961, the S&P was down 28%. The forward 1-year return was up 38. 3 years it was up 69. 5 years it was up 94. And 10 years it was up 171%. So those are some really solid numbers. Another one is, let's look at kind of the worst scenario on this chart is 07, 08, right? The market was down 56%, almost 57%. It took a little bit longer to come back. So the 1 year was up about 7%. 3 years was up about 3.7. But 5 years, it was up 61%. And then 10 years, it was up 209.6%. So even with those really, really challenging times, especially for younger investors, it really just makes sense to stick it out and let the market do what it does, right?
Yeah, be patient. Don't panic.
Exactly. So I always like looking at the stuff and kind of backing it up with evidence because it's easy to say, hey, you need to put all this money to work while the market's kind of falling from grace, and you might lose a little bit to start, but over the long run, in my opinion, it makes the most sense to buy into it, right?
Yep, absolutely.
The last generation is going to be Gen X that it talks about. So this one's a little tougher because they're kind of in, I don't want to say no man's land, but they're kind of in between. So it's nice that they can get some higher yields, but it's also nice that they can buy in at a little bit cheaper. So I guess Gen X is going to be people kind of 55 to 40-ish.
40s and 50s, maybe?
Yeah, 40s, 50s. So they should theoretically be towards their higher earning years. So they should be able to have maybe a little bit excess cash that they could put to work and buy cheaper right now. Yeah. They're also kind of probably considering what's retirement going to look like in 10, 15, 20 years. So that I'm sure that makes them a little bit nervous right now. But maybe there's this kind of a double-edged sword where it's maybe good, maybe bad. But I still think there's opportunities for Gen X right now, right? Because if you have 15, 20 years to still invest, in my opinion, you should be risk on, right?
Yeah, and I think you make a great point that generation is going to be in their highest earning years.
Exactly.
That's a great point. Yeah.
So they'll have the most capital to put to work and take advantage of either of these the most, right? Okay. All righty.
What else you have?
Yeah, that was I really like that article from Ben. But
yeah, that's a good one.
Next is going to be a tweet from Bespoke. Love Bespoke, and this is on 10/17 of 22. So the tweet, I'll just read through it. It said, Walmart, Amazon, Apple, and ExxonMobil are projected to make $1 billion per day in sales next year. Amazon and Walmart are both projected to have right around $600 billion in sales next year, or about $1.64 billion per day. So those are outrageous numbers, and
that's pretty good.
Yeah, that's pretty solid. It's pretty solid. So their sales are going to be drastically higher than most companies' market cap, right? Which I think is pretty funny.
Yeah, wildly higher than
right. There's a really good chart here that says projected 200 billion annual sales club. So it's going to be a lot of the heavy hitters that most people are going to recognize, right? The reason I like this chart is kind of putting things in perspective when the market's down. And I did a little bit of digging on kind of the top four here just to provide a little bit of context. So Amazon is projected to make right around 600 billion next year. Their revenue this year is about, for 22, is about 485 billion. So Walmart is projected to grow. Apple's projected to grow. ExxonMobil's projected to grow a little bit as well. So in my opinion, with the market being down 20, 30% for some of these names and still having projected earnings growth, to me, that's a reason to think that a lot of the damage is done. And one of two things, in my opinion, should happen. As these companies continue to meet and beat earnings expectations and grow, stock prices should come up to reflect that, right? So really, the challenging thing to know is what interest rates are going to do, because obviously as interest rates go up, the multiples and what somebody's willing to pay for a stock goes down. But in my opinion, over time, as these companies continue to grow and meet earnings expectations or beat them even, as interest rates come down, I think stock prices are going to rally.
Yeah, I tend to agree with you. I think think we could be in for some heavy chop over the next month.
Yeah.
Month and a half. But I said that the bottom was in back in when was it? I sat on this podcast and said the bottom was in. I was wrong, so I could be wrong, but I think we chop higher from here.
Yeah, I'm not calling a bottom or calling anything like that, but just in my perspective,
I wouldn't do it on the podcast. By the way, this is not a recommendation for or against any of these names.
Absolutely not. So this is just some data. This is really just kind of if you're looking at the S&P 500, these are going to be the top names, right? So it's just kind of interesting to see that these names are continuing to grow. And I think at some point we're going to get back to normalcy. And the other thing that I think is strong is the economy right now. So what's interesting is the market being down so much, but all of these companies are still extremely strong and still growing. So that's what's kind of strange about right now, is that the market's pulled back quite a bit in a bear market, but the underlying strength of the economy is still there, especially with these large high quality companies, right?
Yeah. And we've talked some about that. It's just a very interesting time. So I think I'll take it from you from here.
Absolutely. Please do.
And I'm going to take us into the Bank of America Fund Manager Survey. And listeners are going to kind of get a 2-for-1 on this, because there was so much good research that came out. This was a really pretty headline survey. And I've talked about this multiple times on the podcast. So a reminder about the report. It's a monthly survey that canvasses the views of approximately 300 institutional, mutual, and hedge fund managers around the world. It's pretty heavily watched. There's tons of different questions that they ask them. So I'm going to read a line from, and this is a tweet from, and I'm probably going to butcher this name, Priapus IQ. And it's just a quote from the report, and it says, BofA's October Global Fund Manager Survey indicates that macro capitulation and investor capitulation have likely been reached, but policy capitulation only just beginning. This means that the big low is unlikely until the first half of next year. So kind of saying the opposite of what you and I just said. So in layman's terms, kind of according to the survey, what does that mean? It means that the heavy selling due to macro and investor sentiment is complete, but that the market still needs to see the light at the end of the tunnel in regards to the Fed rate hike cycle. Right? That's what that line is saying.
Right.
Talking about the different capitulations and whatnot. That's the essence of what they're saying. And I just want to kind of go through a couple of the positives and negatives, because it was so interesting to see the research, because there were some people who were picking the major positive points from the survey, and there were some people that were saying, oh, the big low is not in yet, and lots of different focus. So I wanted to highlight both the pros and the cons for listeners. Great. So some of the positives, obviously the report claimed that macro-driven selling, that panic selling is over. That's a positive. We're at our highest cash levels since 2001. There was a lot of good charts on that. And I don't have that chart. You could probably Google it. That's a good chart out there on that. Think about like percentage of cash in the markets from portfolio managers. Right. It's the highest level since 2001. So.
Yeah, that's interesting to me. So at some point that money is going to have to get put back to work.
Absolutely.
Right? And where is it likely going to go? In my opinion, it's going to go to equities, right? Yeah. Because these fund managers have, maybe I'm stealing some of your thunder here, but they have mandates on equity exposure, right?
Yeah, so they do.
I think a lot of that's going to get worked in, because they can't sit in cash forever, right?
Yeah, especially when you have these big institutional investors, there's going to be a lot of pressure on them to say, you've been sitting in cash for a year now, what are you going to do with it?
Right.
And to your point, I think that cash is going to go to the asset class that has been beaten up the most, and that will be equity. So leading me to my next point, which is that 49% of participants are underweight equities. So 1 out of 2, let's call it. Let's round up to 50, a nice clean number. 1 out of 2 are underweight equities. 79% believe inflation is going to drop in the next 6 months. I don't think that's a huge surprise. We all expect it to drop. And then, a lot expect a rally in the next few quarters. So the negatives, obviously, the call for more pain next year. The big low could come in next year. And I would urge listeners to understand that no one can predict the future. There are good arguments on both sides of the coin. A lot of investing has to do with staying patient and understanding some of the volatility and the times that we're in. And so with that comment, I'm kind of bringing my 2-for-1 here with another tweet from Patrick Sanier. And he says the following: interesting that the BofA fund manager survey shows a lot of bearishness towards equities, yet we haven't seen aggregate outflows. And there's a chart here and that we'll throw up, and at the end of his tweet he says, because that's kind of interesting that we see this huge bearish survey. I would say more of it was bearish than bullish. There's obviously the cash is a pretty positive takeaway. The underweight to equities is a positive takeaway, but it's interesting to see this chart which shows inflows and outflows to equities as a percentage of AUM on a 12-week rolling basis, and you don't see that coming down.
So it's actually slightly positive, isn't it?
It is. It's
people
kind of an
are
interesting,
starting to put
people don't
cash to work maybe a little bit.
Exactly. People, and that's another, and we talk about it all the time on the podcast, but just because you're reading something, just because the institutional money managers in this survey are saying, hey, I'm really bearish, that doesn't always mean that's exactly what they're doing.
Yeah, I mean,
right?
I've probably said this before, but every poll, every survey, all that stuff I take with a grain of salt, right? Because there's so much data that can be manipulated with who they're asking these surveys to, right? And I mean, none of these fund managers are going to describe exactly what they're doing, right? So
exactly,
it's a secret. They all have their own thesis and their own ways of managing money. So
Especially
they're probably not going to put that on the table for everyone to see, right?
Yeah, especially in the hedge fund industry. It's not surprising to see headlines and you get underlying data 2-3 months later, and it actually indicated that they were doing the exact opposite of what they said those previous months. There's been some good research on that. So, you have any other comments on the survey?
No, I think that's really interesting. I think kind of the positives and negatives you laid out, in my opinion, it's probably somewhere in the middle, right? So all the positives, all the negatives, the truth usually lies somewhere in the middle, right?
It really does. So it's an interesting time. We'll see what happens from here. So I promised an update on corporate earnings. So my next comment here is on big bank earnings, and I really just took the intro to this article. It's from Zero Hedge as an article on Tuesday on the 18th. And at the beginning of the article, he has a nice recap of the earnings, which I thought listeners would appreciate. So the quote is the following: concluding the big bank Q3 earnings reports, some of which were disappointing, Morgan Stanley, some of which were mediocre, JP Morgan, Citi, and Wells Fargo, some of which were spectacular, Bank of America. Moments ago, Goldman Sachs reported a 43% year-over-year drop in Q3 profits as the Wall Street giant suffered from a continuing slowdown in investment banking fees and asset management revenue. So, to summarize in layman's terms, like we said at the beginning of the podcast, there's been...
Some are really good.
Some are really good. Some are not so good. There's some negative takeaways with investment banking and trading coming down. I don't think that's a huge surprise given the market that we're in, given some of the risks that we're seeing and the rates coming up. And it'll be interesting to see how that changes over the next few quarters. But overall, I would say earnings have been ranging from average to good. And probably the most interesting point I have for listeners is that the sector, generally speaking, was rewarded. So when you look at the actual banking index, we're not just talking about financials. Financials were up around 1% since the market low on 10/13. But the banking sector since the low on the 13th, which would capture all the earnings that we've seen, is up 3.3% since.
So a pretty good reaction.
All in all, a good reaction. So I've mentioned this before, I think maybe last week, maybe 2 weeks ago, and I've talked with Matt and Mark about this. with corporate profits and earnings consensus, I think what the market would love is for earnings not to be really weak. Really
Right.
weak might mean that, okay, we need to discount this more. We need to sell more. So you don't want really weak. But I also think if it's too strong, the market might say, well, we're not there yet.
Yeah, we're not at the bottom yet.
Right.
We're still waiting for more economic
more turmoil.
downturn, right?
We need
Exactly.
more turmoil. And so what I kind of expect to see is similar to what we saw in the bank earnings, where you kind of see a little bit more of a dispersion, where some are doing
kind of
pretty
that
well.
average to good range.
Yeah,
kinda
some are
evens
doing
out.
not so well, and it all kind of evens out. I think that's what the market's going to want to see. We want to see some of these consensus numbers come down a little bit, but not massive. Now, that's my opinion.
Yeah, no, I think that really makes sense because, I mean, the market is pricing in a recession right now, right? Or the slowing of GDP. So you would expect some of these companies are going to slow a little bit.
Yeah.
Some might be able to hold up a little bit better. And it's going to be individualized because companies are going to navigate better through
Absolutely.
turmoil better than others, right? So I think your point makes sense, and I do think that maybe it's kind of that sweet spot where it's what the market's expecting, right?
Let's hope we hit the sweet spot.
Right.
We would all love for that to happen. This has not been fun. So.
Yes.
And then a last comment on earnings for everyone is just a reminder that we're really in the swing of it now, and big tech earnings will be coming out next week, and so you're going to see a lot of the S&P 500 reporting over the next week, over the next 2-3 weeks is kind of the meat of the earnings season. So expect to see some individual names with some volatility. That's normal. You're going to see that for sure in this market.
Absolutely.
So,
yep.
the last piece of research is it's a quick one for you, and this is just an interesting comment, and it's a interesting statistic. It's a weekly performance for the S&P 500 throughout 2022. This is a tweet from Michael Gade. He's a CFA at the Lead Lag Report. It's a piece of research that we like and we subscribe to. And Michael says the following. The number of weeks down for the S&P 500 as a percentage of the year is second only to 1931. You have been conditioned to be bearish because of the sequence this year. Opportunity always exists when the crowd thinks it knows an unknowable future. Few understand this. So let me break that down quickly. He's saying that 1 week performance, so not one day, but the Monday to Friday, that's your 1 week. And so that's measuring 1 week. And he's saying that the number of weeks down for the S&P 500 as a percentage of this year is second only to 1931. That's a wild statistic.
It is a wild statistic.
Very interesting. And when you see week after week, down, like we've seen this year, it's easy to get really bearish. The BofA Fund Manager Survey, it's easy to come out and say the world's going to end. You see doomsday articles popping up, and
those lovely CNBC headlines.
The lovely headlines that we see. It's easy to think that way, but he makes an excellent point that opportunities always exist when the crowd thinks it knows an unknowable future. We don't know that the market's going to go lower, just like we don't know that it's going to go higher. But what we can do is we can take a look at where the market is. We can look at corporate profits and
look back at history and what things have done.
Stick with your plan with your advisor and make the best decision at the moment.
Yeah,
so.
I think that's great, and it's kind of that contrarian thought is like when everybody thinks it's doomsday. What tends to happen? Sometimes it's the opposite.
Probably found your bottom.
Yeah, exactly. So it's funny. So I think that's a really good way to put it in perspective on how challenging of a year it's been for the market, and to kind of stick to your guns and not make rash decisions as well, right? So you gotta, if you have a plan and you have your investment thesis, stick to it, stay in the market, and it tends to work out pretty well, right?
Absolutely.
That's great. I love that one.
So what do you have for us on financial planning this week?
I got a good financial planning topic of the week. So most people were kind of getting close to RMD season here. So for anyone that's not aware of the term RMD, it's a required minimum distribution. So for people above age 72, the government forces you to take money out and pay taxes on it, right? Out of anything, it could be a 401k, it could be an IRA. So
Any retirement account.
Exactly. So tax deferred money. So the topic I wanted to cover today is something called a QCD, or a qualified charitable distribution. So the finance world loves their abbreviations. So RMDs and QCDs go really hand in hand. The jargon is great. So a QCD is a way to essentially donate what your RMD might be, and you essentially get not taxed on that money, right? So anyone that's due an RMD or has to take one, say they're above 72, say they have to take out $10,000 out of an IRA this year, they have the ability to donate that to a 501c3 organization or charity, and you're not taxed on that money. So it's a really solid strategy for people that maybe have an RMD for the first time, and they maybe don't want to bump themselves up to the next tax bracket by this RMD. Or if you're charitably inclined in general, it's a really, really tax efficient way to do that, because you don't have to itemize. You essentially just, it's like you didn't make that money, right? So if somebody is charitably inclined, you can donate up to $100,000 to a QCD each year. So it's a really, really solid strategy. So just kind of made me think of it during the RMD season that QCDs come out. Right?
Yeah, that's a great point to think about the tax bracket too.
Yeah, exactly. So it's a really good strategy for those that are charitably inclined. Okay.
Well, do you
have anything else?
Yeah, anything else you have for listeners?
I think I am good. I think we're just going to continue to chug through this challenging market, and I know Matt and Mark will keep bringing good info to listeners throughout the rest of the year and next year. So make sure to keep checking in and get some good info.
Absolutely. It's been fun. So thank you for listening to the episode 172 of the Independent Advisors podcast. And we hope everyone has a wonderful week. Thanks so much.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.